IFRS 4 Insurance Contracts. Effective date periods beginning or on or after 1st January 2005. Scope. This standard applies to insurance contracts that an entity issues and reinsurance contracts that it holds. Financial instruments that an entity issues with a discretionary preparation feature. If insurance contracts include a deposit component, unbundling may be required. The following are examples of contracts that are insurance contracts if the transfer of insurance risk is significant. Insurance against theft or damage to property. Insurance against product liability, professional liability, civil liability, or legal expenses. Life insurance and prepaid funeral expenses. Life contingent annuities and pensions. Disability and medical cover. Surety bonds, fidelity bonds, performance bonds, and bid bonds. Credit insurance that provides for specified payments to be made to reimburse the holder for a loss it incurs because of a specified debtor fails to make payment when due. Product warranties, other than those issued directly by a manufacturer, dealer, or retailer. Title insurance, travel assistance, catastrophe bonds that provide for reduced payments of principal, interest, or both of a specified event adversely affects the issuer of the bond. Insurance swaps and other contracts that require a payment based on changes in climatic, geological, or other physical variables that are specific to a party to the contract. Reinsurance contracts. The following are the examples of items that are not insurance contracts. Investment contracts that have the legal form of an insurance contract but does not expose the insurer to significant risk. Contracts that pass all significant insurance risk back to the policyholder. Self-insurance that is retaining a risk that could have been covered by insurance. Gambling contracts. Derivatives that expose one party to financial risk but not insurance risk. A credit a credit related guarantee. Product warranties issued directly by a manufacturer, dealer, or retailer. Financial guarantee contracts accounted for under IAS 39 Financial Instruments Recognition and Measurement. Does not address the accounting for financial assets held by insurance, but temporary exemption from the requirement to apply IFRS 9 is available until 1st January 2023. An overall approach permitted for designed designated financial assets. Liability adequacy test. An insurance is required to assess at the end of each reporting period whether its recognized insurance liabilities are adequate using current estimates of future cash flows under its insurance contracts. If that assessment shows that the carrying amount of its insurance liabilities is not sufficient, the liability is increased and a corresponding expense is recognized in profit or loss. Areas of additional guidance. Additional guidance is applied in IFRS 4 in relation to changes in accounting policies, prudence, insurance contracts acquired in a business combination or portfolio transfer, discretionary participation features. It is highly recommended that insurers gain a full understanding of IFRS 4 as requirements and disclosures are onerous. Disclosure. An insurer is required to disclose information that identifies and explains the amounts arising from insurance contracts, its accounting policies for insurance contracts and related assets, liabilities, income, and expense. Recognized assets, liabilities, income, and expense. The process used to determine the assumptions that have the greatest effect on measurement. The effect of any changes in assumptions. Reconciliation of changes in liabilities and assets. An insurer is required to disclose information that enables user of its financial statements to evaluate the nature and extent of risks arising from insurance contracts, its objectives, policies, and processes for managing risks, information about insurance risk, information about credit risk, liquidity risk, and market risk, information about exposures to market risk arising from embedded derivatives. Thank you.